And welcome to the Hot Bizfluent podcast, where we get all up in your business. So let's talk. Today's guests are brought to you by Crush City Realty Group, your premier Houston real estate experts, and luxury real estate agent Alyssa Emmons, where everything she touches turns to sold. And finally, Covo Capital, fast, flexible financing for all your commercial lending needs. This podcast is for informational purposes only. The views expressed in this podcast may not be those of the Bizfluent podcast or management. Don't forget to stay to the end to find out how to get some of our amazing merch. Now let's get down to business.
Hey everybody. So today we're going to be doing things a little bit different. So as you can see from the title, it's new year, new you, new startup. So Josh, it's the beginning of the year. Yeah, sure. It's January 22nd. I guess first things, we need to re-record everything. Josh and I know that we still are saying Miss Alyssa Emmons, and we love her.
Still in our hearts.
Yeah, but she's not with us anymore when it comes to the podcast, and so she'll very likely be an interviewee with us, but she stepped away. So that being said, it's January. This is when everybody starts their New Year's resolutions. New me, new year, new you, right? First quarter is also a really good time. Oh my goodness, excuse me. That came out of nowhere.
New bloated air in your belly.
Yeah, no joke. So, you know, the first quarter is also a really good time to look at potentially starting a business. You know, it's usually slower. So when it comes to most businesses aren't picking up until the second quarter. So if you're looking to start a business where you need at least one or two employees are usually a little bit easier to find in the first quarter. On top of that, banks are trying to revamp and get ready for the new year. They've got their projections that they've got to give away. So let's start with that. You know, banks have been handed their quota. This is how much money they need to lend out. How does that work? And why does it benefit us to go ahead and get started now?
Oh man, that's such a big question.
Right.
I'll break it down. Generally, it's not, I would say it's not, each individual banker is going to get a quota. They're going to be, I'd say rural and small bankers and most bankers, Banker One, BDOs, you know, any number of the titles that they give, depending on if it's a credit union or a small bank, SBA or other, is going to be around 10 million for the year. To be conservative. Brand new bankers are going to give a little bit lower, but for the most part, every banker is going to be at least a $10 million need. Now, they're also going to get, I forget what it's called, but they generally get a graph that is, and maybe you know this one, JP. What's the circle graph? Is it a circle graph that the
pie
middle?
Chart?
No, not a pie chart. The one where the two circles overlap and the middle has like an eye.
Oh, a Venn diagram.
A Venn diagram. Okay.
Yeah.
They typically give a Venn diagram out, and what it's going to be is a green. This is what we want to go after in industries and types of business. The middle is going to be the yellow. We want this possibly, but within certain parameters and also within certain regions. I know we've discussed this before, but like, let's say you are a nonprofit. Most banks will deal with nonprofits, but they don't want their portfolio to be nonprofit heavy. So if they already have a lot of nonprofits, while it could be a yellow or even a green, it's if they already have a loaded portfolio, they're not going to want it either. And then of course you have your other side, which will be the reds that almost always know. Now that you'll never see this published, which is an interesting fact. And in fact, I remember in my younger career days with Wells Fargo, I got in trouble for specifying what we liked and didn't like. But I think this is great.
Weird. It's really
I
weird.
think this is a great thing to share with people that they don't understand. And now that I don't work for the banks, I can say this.
Right.
Legally, a bank cannot specify what they will or will not give a loan out to. So they're very tight when they send these Venn diagrams out as well. I think legally they're allowed to have that within the bank, but they can't specify that outside the bank. And in fact, like I said, I've gotten in trouble for literally stating with a COI, a center of influence partner of mine, I was like, hey man, this is what we want. This is the ones we really like. This is the ones we don't.
Yeah. It's really weird. Why is it illegal?
Because again, the everybody has SBA loans. Banks are tight with the government. They have government regulations where it states you have to loan to everybody. Now, here's the caveat and the way that the banks get around it.
Oh, hold on. So here's the thing that's weird, and I'm saying this as a guy that wants to start up a number of businesses. So here's the deal. Like, they say the bank has to loan to everybody, and I don't disagree with that, but they don't have to loan to everybody for everything, do they?
Certain qualifications, correct. So they can go, do you make enough money? Do you
Yeah.
have enough cash flow? Do you is your credit a good score? Those type of things are legally okay. What they can't go to is say, well, you're a restaurant, and so we can't lend you. Well, you're retail, so we can't lend you. So risk, even though there's obviously risk in those industries, they can't specifically state that. And so what they do to get around it is they give, in my mind, bad loans. For instance, if you
Yeah.
came in as a restaurant retail and you went to Wells Fargo and you said, hey, I want to get this business started, I don't even care if you have experience. Now, this is primarily the big banks. I won't say that every bank or lender is created the same, ergo why you would use a broker to find people outside of banking. But in a general standard way, even with small and regional banks, this will ring true. If you go to them with a restaurant retail, they're either going to nitpick and find things, or they're going to say, we'll loan to you, but your LTV is going to be 50%. So that means you've got to inject 50%. You want a $100,000 loan? Obviously not enough for a restaurant, but let's say you did a $100,000 loan for number's sake. You've got to come up with $50,000 to inject, and you get 50,000. Anyone who looks at that loan is going to go, well, why am I doing a loan then? Because I'm already paying 50% of it. It's not advantageous to the user, but that's how they get around it. And that's what you'll see. 500,000, you need to have $250,000 down. It's not an advantageous loan. But if you use good consultants on that, there are ways to get around that and find the lenders that are non-traditional that know the industry. And that's another key component. Does your bank know the industry? They don't know your industry and they don't like your industry, either one, you're probably not going to get lent to in that space, or you're going to get a very bad loan.
So that, just as a guy that's trying to start a business and I'm trying to bring you a loan or trying to bring you some business, the thing is you're not saying that they won't lend to me. They're gonna make it either such a bad loan that it's just not advantageous for me to work with you, or they're going to make it so strict that it's almost impossible for me to meet their criteria.
Correct. And keep in mind, everything we say is with exceptions. There will be exceptions. If Fertitta goes to a bank and says, hey, I want to open a restaurant, they're not going to give him that loan. They're going to give him a better rate. They're going to give him a better loan because he's an industry titan in restaurants. It's just any high risk one or one that they don't understand, they will not give you an advantageous loan. They're gonna mark those terms up, and they're allowed to do that.
And we're not talking about the Titans, right? So we're not talking about the Titans. We're talking about the average Joe.
Yep.
And so the thing is,
your Papas, your Fertittas here, they'll have no problem. But even them, they will look at it a little different. But what you would get and what they would get, two totally different things. And again, they can rationalize that because they can say, hey, government, this is Fertitta. He's got tons of money. If he doesn't default on restaurants, it's not the new guy.
He doesn't default, period, right? Like, so this dude's billionaire kind of guy. They're like, they'll if he was trying to do something ultra risky because he's a billionaire, they would say, look, here's the deal. We don't want to lend on this, but if you put the Rockets ownership up for collateral, then we'll take the loan.
Yep.
If you put up one of your name brands where we have the chance to take that name brand away from you as collateral, then we'll back the loan. So he can do whatever he wants, but that's because he's got multi-billion dollars worth of land and business rights that he has to back him on top of that. But I don't. I make $100,000 to $150,000 a year, and I need to start a business. And so the first thing that I need to do is I need to be able to, number one, come up with a business plan, right? And somewhere, one of these sides, I'm going to try to do my first link up. And that's one of the reasons why, especially if you're new and you're not surrounded by lawyers and you're not surrounded by people that know these things, and that you don't have somebody like Josh you can just go to like I do. Um, it's really, really, really important to get in contact with Amy over at the SBDC, the Small Business Development Center. She's
Use
going to,
those free resources.
yep, she's a free resource. They have classes. She's going to walk you through everything it's going to take in order to get your business up and running. So that way, when you go meet a bank, then you're ready to go. So somewhere up here, I'm going to link that out.
And if you're not, keep in mind too, if you're not in the Houston local market and you're happening to watch us from outside, every state and every major city generally has some sort of SBDC office. So
it's a
reach out to
federal
them,
program, right?
reach out to them and get that. I wanted to add one more too. So we said restaurants and retail because it's important to figure out what type of business you want, where we're at right now in the startup phase. Another one that's really hard to do too is think of in lending. Lending wants collateral, cash flow, and credit. They want all three. There are ways to operate on strong on just one, but they want all three. The reason this industry and this type of business is tough is because they're very weak on these things, and that is if you are a distributor. Most distributors lease a piece of property. They don't own the stuff. They're passing it on. It's strictly a sales arm. So I'm not saying that those can't be very good businesses, and I would say they are less risky than retail or restaurant, but they are also one that's very difficult to lend to in many of the circumstances that those businesses find themselves in. So keep in mind when you're picking a business, pick one that's in a strong industry so that you start off on a good foot.
Collateral based industry.
Collateral
based industry.
And if you can afford to get property, get it first. If you can't, leasing's fine, but your next phase should always be to buy property next because it gives you so much more leverage in the in the future.
Long run. Yeah.
Yep.
And at the end of the day, the more property you have, the more leverage you have, period. One of my clients actually had like 4 or 5 rent houses, and they went with they tried to go with the 0% down SBA loan. And by the way, for you people that always like to say, well, rich people don't put their own cash into it, that's not really true. There's something there. So even this 0% SBA loan that my client did, there wasn't enough meat on the piece of property that they were buying. And so because there was not going to be enough equity in the property they were buying, they had to make up that difference. And so they used 2 or 3 of the homes that they own outright that are rent homes to make up for their collateral. So yes, they did not use any cash down.
Was that a startup business, JP?
It was not a startup business. That was the other thing.
They were existing.
So
keep in mind, I just want to make sure I point out that detail. When you look at lower rate loans that are the 10, 15% and under and up to 0%, because remember, SBA can go as low as 0%. So anytime you go to a bank and they tell you the minimum is this, that's not correct. That is a bank set margin. That is not an SBA set margin. But anyways, to his point, this not being a startup, but we're discussing startups. Keep in mind, your startups are going to be 25%. 25% down almost always. You can almost consider that a minimum almost always, no matter where you go.
And so that
only if there's property and if there's not a startup, it's an existing business. That's when you can get the better rates and lower down.
That means that you're going to need at least a minimum of $25,000 plus closing costs of every loan you get. There is no such thing as rich people don't use their money. It's not that. Rich people use their collateral, and their collateral.
Rich people tend to buy existing businesses. They don't do a lot of startup.
Correct. So that also kind of comes into a misnomer, a misunderstanding. I was talking to a real estate agent, a residential agent at my office the other day, who is selling one of his rental properties. He doesn't feel like is making money. And he's walking away because he thinks it's just not worth his time and his effort, and that he could earn money elsewhere doing something else with that time. And so it just so happened that the following day one of my teammates called me and was talking about money and rent houses type kind of thing. And honestly, your business is going to be based on a couple of things as well. And so you have to understand this before you go into business. And I don't care if it's rent houses, property ownership, or what it is. But when it comes, well, I shouldn't say or what it is. When it comes to property ownership, when it comes down to property ownership, you should be always at bare minimum be breaking even. If you're breaking even, you're still earning money. But in this particular case, this gentleman, the realtor, had purchased this piece of property during COVID, I believe anyway. And during COVID, um, we're looking at the fact that he got probably a pretty low down payment loan. Even if you said it was 20%, somewhere between 15 and 20% down payment, a really low interest rate, which is what allowed him to lease his house out and break even. Now, he wasn't saving money for repairs, so that still comes right out of your pocket. And he was like, well, I'm not making any real money off of it, so I'm going to sell it. When you buy a home or a piece of property, I don't care if it's investment or if it's for yourself, and you put down the bare minimum, such as 25%, the money that you're making is money on borrowed interest. So when you pay, if you can break even through your regular bank payment or from your mortgage, paying your mortgage, then the 4% or 5% per annum increase in property value that you're receiving is receiving off of borrowed money. That's not your money. The money that you invested at the bare minimum of 20 or 25% is being paid to you by your company or by somebody renting the space from you, that you're paying the bank. And so the money you're actually earning is not 6% on your 25% down, which is nothing. I mean, seriously, 6% of $25,000 is what? Do we do? Let's do the math.
You want me to figure that out?
I know
6% on 25. So that would be 6,000.
$1,500 a
Yeah,
year,
I was gonna say
but
12 plus the 5.
your home value isn't going up $1,500 a year. It's going up an average of 16% in gross. So your home value, if you put 25% down, say $25,000, and it's $1,500 that it goes up, really it's $100,000 house, and that's $6,000. So $4,500 a year of your realized um, increase in value isn't even from your money. So you're acting just like those rich people that don't put money down. You are earning a value off of money that you still have not paid for. And so when you turn around and you sell that house, the bank doesn't say, "Hey, wait, that 4,500 of the 6,000 is mine." They say, "Hey, you're the one that took the risk, figured out how to pay the note. So for every year, that extra 4,500 bucks belongs to you." And so you have to realize that if you can break even, you're making money when it comes to property ownership, period.
Yeah, it's a long-term investment, and then it goes back to the saying, it doesn't matter what type of business you're in, the least risky are gonna be the lower margins. That's why it's a lower margin recovery, because it's the least risky, and property is the least risky. That's why it's
Yep.
easier to get loans on it. It's easier to, see an income off it, but it's, it's I don't wanna say pennies on the dollar, but typically, I know I looked at my house a number of years ago because 'cause we've been looking at eventually getting another house, and, mine has some special circumstances that kinda make it difficult because 'cause we're by the water and insurance and everything else. But the average rent over here for our size home is like $2,800.
Mm-hmm.
But our mortgage and insurance and taxes and everything is closer to 18, 1900. So
Right.
I'm maybe making $900, but that $900 a month also is not profit. I also have to keep that for AC repair, flooring, any of these things. Now I can pass some of that on to the client, the renter, but and this is where a lot of people get burned is they don't properly vet their they're renters, and then they get into
Well, you should expect all of your renters to be bad renters from the very beginning. You should just automatically assume that they're going to destroy your house, and you're going to have to replace $5,000 worth of flooring. You're going to have to replace, all the
we
other
should have
stuff.
talked about property renting instead of startups.
Well, so we're going back around, but that actually goes back to kind of one of the things I was gonna lead into anyway, is knowing the difference between margin, capitalization rate, and your return on investment. Because those things all, if you look at the definition, are very, very closely related, but also very separate in different ways. It's also a capitalization rate or an OR could be about the same thing. And so ROI, quick definition for y'all that are new, is a return on investment. And OR is your operating ratio. How much of your gross income do you spend to operate your business? Which also the same.
Let me tie into that. So, and to tie into that for lending would be your cash flow.
Right.
So, and when you look at cash flow, you'll hear you need to be at least at 1.25. Now, this would be on commercial buildings, not so much on a retail, but you'd still want to look at this, what your cash flow is if you've got a portfolio of homes, because again, that would be a business or investment properties. But your rate of your cash flow is calculated at 1.25, a minimum of 1.25 for most lenders. Well, that means for every dollar you're spending, you're making $1.25. So you want to see that your rate of return or your rate of investment is breeding those types of cash flow numbers.
So what you're saying is no. So that's a good one. It's the lending perspective. People need to understand, because it's about to get really convoluted if you don't understand these things. So in a lot of industries, like the trucking industry, operating at a 95 OR is a great operational return. No, it's not return. It's, oh my God, I just said it too. Operating.
I thought you said OR.
Yeah. Oh my God, I cannot believe I just said it. Anyway, so running at a 95 OR is operating ratio. There we go. So your 95 OR means that for every $100 you bring in, you spend 95 to stay in business. And people go, well, that seems really crazy. Well, that's because when we talk about trucking, I'm talking about for a bigger business, not smaller trucks. Smaller trucking companies have a much, much better OR, where you're looking at like an 80 to 85 OR. They make a heck of a lot more profit. But just like all things, when it comes to scaling a business, eventually you get to a point where you stop making more money and you just service more business at a lower rate per transaction.
Now, would you say it would stop, or would you say growth would slow? Because technically you're always trying to find growth in a market, but obviously there's a finite number of a market. And especially if you're a small dog,
the only way you're going to see a continued growth is if you're a niche oriented business. And this is actually really good conversation for a startup too, is understanding the difference between being in business and being in a niche oriented business. And so, like, if you were going to start a trucking company and you wanted to haul dry vans, but you didn't want to haul any hazardous materials, you didn't want to haul anything liquid, you didn't want to haul anything overweight, and you wanted to really just hit all the big major broad stroke stuff, and you're like, okay, cool, I'm going to do nothing but work for Walmart or UPS, and that's it. It's always super light, super easy, super fast. Then you're going to get the lowest pay out there, and you're definitely going to see a diminishing return per truck the more you grow. The more business you can offer, the more you're going to need, or the more you can handle, the lower your prices are going to go, but you're still going to be paying for your trucks the average rate, and you're still going to be paying your drivers an average rate. Fuel cost is always going to be average across the board, no matter where in the country you are. those things don't change, but you're going to be reducing the prices that you're charging these companies because they're offering you a higher volume of business. So where you have to get your niche market in the trucking industry is by hauling hazardous materials. And there's a lot of people that are like, well, we'll haul basics. We don't want to haul the crazy stuff. Well, eventually, if you want to make more and more money, you have to get more and more and more niche where you're saying, you know what, all I want to haul is like nuclear waste, something insane that most people are like, oh, I would never touch that. Well, that's why the people who haul nuclear waste make so much dang money. The reason why people who specialize in anything make money is because when it comes down to it, everybody else is all they see is dollar signs everywhere. And what they're not seeing is they're spreading themselves thin across a lot of things as opposed to focusing and getting really fat on one niche item.
I've got a similar story with that because my cousin's late uncle, Uncle Bob, hilarious dude, love the guy. But and it's fitting that he was in this market, but he was a distributor of poultry. He was one of the largest distributors of poultry between Arizona and Texas, Oklahoma, that little niche of territory there. And I think the business is still running by one of his daughters, but he never really expanded. And I remember towards the end of his life, was every time we go to the beach house, he's still running his, in distribution. You're always running. There's no days off. And so I just remember him talking about his margins. I'm suffering here, I'm suffering there, and he's making good money, but it's a misnomer and a false premise that if you think you're getting into business to make all this money. Most businesses, in fact, JP, for the project we're working on, I'm going through my the business plan and the projections. We're spending more money than we're making. We're making good money, but we spend far more money than we actually make.
Right.
And that's the reality of business. And then if you are in a general space like a Walmart and you're selling a Walmart, again, it goes back to what we just talked about, risk versus reward. If you're staying with Walmart, it's a cushy contract. You're gonna have 5, 10, however many year contracts. You're gonna do simple loads. They're not gonna be dangerous. And so
easy, fast pay most of the time.
Yeah, and so you're all in there. But as they increase your involvement in their company for distribution, you are not getting paid as much per truck as you expand. And so that's where you also need to think is your expansion is not just with one client, it's with multiple clients. On my side of things, and even within my old expertise of being in manufacturing, I remember, and actually lenders do look at this. I recall I went to see she was the accountant, the in-house accountant. She was basically running the business. It was an old family business. The lady that owned it also owned a couple other things. She had some storage units and stuff. And the company was making money. And this when I was at Wells Fargo. So this gives you an idea of what Wells Fargo looks at as well. And the problem was, though, they only had like 3 clients. And she was happy with that. They were making millions off 3 clients.
Not diverse enough. It's not diverse enough to spread out the load. You lose one client, you lose your whole business.
And lenders will look at that. And our thought was, if you lose, their biggest client was almost 50% of their business. They lose that, they lose 50% of the business. And because it was an old, so they look at owners and they look at what's the exit strategies and all these other things. You'll hear exit strategies a lot. Well, because it was basically a dormant owner, as we would call them, it was not a good lending option. The loan that we would have offered them was at a much higher percentage because the risk was higher. And so it just ended up not being a good client for us. And they didn't understand because think of it from their perspective. Well, we're making good money. We've been in business 60 years. We've got some clients. They're good clients. They were big name clients. But one client left and that business was exposed and there was so much risk on that. And because the owner was older and didn't have the willpower to go after new clients, and we knew that, it became the red flags that we were looking for to say, no, this deal is just not for us. And we could justify that.
Right.
So keep that in mind too. We have talked about startups. We're talking about startups today. but we'll and I'm not going to discourage people from a startup. I'm just going to be realistic and say
God, no.
a startup is the hardest thing you can do. So I always tell people, find one that's existing, find one
But wouldn't you also agree though that a startup is the easiest thing for somebody who has very little to get started in?
it can be. There's a lot of opportunities through SBA and other things,
Right.
but I would say startups have become more difficult. I will say startups have been a lot harder within the last even 5 years. You'll see
Why do
just like
you think that? Why do you feel it that way? In startup, do you have a specific thing that you've noticed is the hardest thing to work with? Is it like
it's the
startup
catch 22.
restaurants,
It's going to
startup?
be exactly what all these college students bitch about. When you
Yeah.
get out of college, you go, okay, I got to go get a job. And so you go looking for a job. You're all
Yep.
excited. You got all these referrals, whatever, but you haven't worked yet. And you go to these jobs and like, oh, we like that you worked hard in college, but you don't have any experience. Well, I'm doing this so I can get experience. So that's what startups have become in my mind and why it's so difficult. They want physical experience. Ergo, why I'm on being on this loan with this project we've been kind of referring to.
Right.
But you have to have experience. You can't just go, I got a great recipe. I know it's great. All my friends love it. We'll have you put it into a business. Have you sold it? Have you managed a restaurant? Do you have the experience? That's probably the biggest key. Experience. The requirement for experience has changed and drastically gotten tighter compared to 6-7 years ago. You could have gone in and gone, well, I've got the money. I'm ready to go. And SBA might have backed you.
Right. And
Now,
so
not so much.
maybe that's the thing. So here's experience is a big deal. And here's the reason why. My wife and I were just having a conversation about this, not but just 25 or 30 minutes ago before we started the podcast. It's a really big misnomer. And I'm going to go back to the trucking industry because it's something that I noticed more than anything ever. And I was in trucking for 18 years before I became a real estate agent. And so I've done everything in the business except for drive an actual truck or be an owner. So I've been in management. I've been in customer service. I've been in dispatch. I spent the majority of my time in dispatch. I've been in sales. I've run a warehouse. I've operated forklifts. I've done everything from hand loading the lowest of low all the way to managing and running a warehouse and dispatch type kind of stuff. And so the biggest misnomer and understanding that so many people have is that I'm tired of being told what to do. So I want to be my own boss so that I never have to be told. I'm the one telling me what to do. If that's the only reason you're starting your own business, then you're in the wrong business. You're going to fail. You just need to be an employee, suck it up and realize that. Now, if your heart is set on something that you're struggling with and you know that, hey, it's not about not being told what to do, but being able to set your own schedule, you'll find very quickly that really you don't set your own schedule. Your business dictates your schedule.
You're a slave to your business.
Right, because
your boss is the business now. and to an extent, your employees.
Yeah, no, I mean, so a couple of years ago when Flora and I were in Puerto Rico, my wife took pictures of me walking around the beach with my cell phone in my hand up to the side of my head. I had a deal falling apart, and so every day was a fight and a struggle to keep it going. I'm in the middle of Puerto Rico, just one of the most gorgeous places on earth, like busting my butt. I'm not working. I might as well have been in my office. It was no different than being in my office because my vacation, the downtime and everything was really just not there. And I mean, it happens a lot. Like I'm not working. Like there is not very many times where I'm just not working. I go on vacation, take my computer. If I go anywhere, take my computer. My cell phone's with me all the time. My clients know that I'm available. They pick up the phone, they call. I don't have somebody to handle my stuff for me.
Well, because a lot of time for you and me, the deals are it's first to answer. And if you don't answer, they ain't going to wait for you. They're going to call the next one.
Right.
So
the deal is when you start your own business, you are the boss, but not really. Like Josh said, the business is your boss, and the business dictates what you have, what you do and don't have to do.
And
And so,
that sounds so terrible, but at the same time, if you're not listening to your business, that's a problem in and of itself.
yeah,
If you're just running around doing whatever you want to do and you're not paying attention to the red flags popping up that will eventually and ultimately do pop up so you can make adjustments so that you can,
right,
negate something, do something else, whatever it is, then you're
right.
not being a good business owner anyways. So,
Well, and the thing is, and at the end of the day, what most employees miss is the risk and hard work that the entrepreneur that is employing them puts into it. Um, if you want to go and you want to work an 8 to 5 job, go work your 8 to 5 job. I almost guarantee you, majority of the people who are bosses, supervisors, managers, entrepreneurs, VPs, they don't work 8 to 5. They might be in the office from 8 to 5, but they're definitely putting in far more hours, travel time. There's something being sacrificed, and majority of the time, it's time with family and friends that's being sacrificed. Um, and then when it comes to the entrepreneur, it's time with family and friends that's being sacrificed, as well as the as large amounts of money, which is just a ton of stress. Um, Watching your bank account just up and down, because every
yeah,
time it puts something
there's
up,
a big difference between you have a paycheck, your paycheck is that paycheck every single month, and you can depend on that paycheck for the most part every single month because your
yeah,
employer wants to keep you if you're doing your job. The owner is, okay, I got a ton of money this month. I don't have a ton of money this month. I got a ton of money this month. And
right,
and if you don't have any money, and there's many times in businesses I've had, all I was doing was paying my employees. I wasn't getting any paycheck that month. Sometimes I
right,
was going in the red a little bit that month. Now
right.
it's a lot of my stuff was seasonal too, but the stress and that's why it really. I'm not offended by millionaires and billionaires, and in fact, if you look at them, they technically give percentage wise way more than most of us do, and even the charitable ones. My percentage of my income that I would donate is probably I'd say in that 5 to 8% range, the typical range.
Right.
Some don't donate anything. I tend to try and donate my time too. A person who's a billionaire, 5 to 7% of their thing is millions,
Yeah.
millions.
Yeah.
So, and it's all at a cost. My uncle is the former CEO and chairman for Ingersoll Rand, huge conglomerate. When he was there, they bought out Bobcat, Club
Yep.
Car, some big names. And, I respect my uncle. He's always been a mentor to me. And the guy started from nothing, went to Purdue, earned a great degree, busted his butt, went to be a salesperson for them, and slowly worked his way up. I mean, he sacrificed a ton. He had a divorce, while he had
Just
a
like
young
your aunt.
child.
Your aunt, same thing with the what's the
Oh yeah,
company that
Kathy. Yeah,
Kathy
Kathy, same
Kathy
thing.
Smith made
Sacrificed a
food.
lot, and that's what people don't see. That's where the selfishness comes in because I'm going to respect someone who's giving that much work. I might not want to do that much work, and I really don't. But I can respect the fact that they've done that much work to get that much return. Whereas most of these
So
people who
your
criticize,
sacrifices, I think that's one of the biggest things and I'm not using this as a hey, you need to go to college type kind of deal, because I definitely don't have a college degree. But it's one of the things that's completely and totally misunderstood is when you sacrifice early in life, that sacrifice is not sacrifice. Well, I shouldn't say it is a sacrifice.
there's a return.
But if you, as would say it, a really good friend of mine the other day told me, JP, it is a sacrifice, but the way I like to look at it is it's deferred gratification.
Yep.
And so you take, like, I hate school. Like there was just no way I would have never done good in college. I hate college. I hated school. It just was not, it's not my bag. But the people who go to school and deal with it, they sacrifice so much at the very beginning because it gives them 5 or 6 years worth of working in a 3.5 to 4 year period of time. But you got to look at this, man. These kids go to school 12 hours a day, 9 to 12 hours a day. They've got 5 to 6 hours worth of homework every single day. It doesn't take a genius to graduate from college. It takes somebody who's willing to bust their butt, pay the money to get the piece of paper. And you have to be able to be willing to put up with a bunch of crap. I have met plenty of people who've had professors that absolutely refuse to give anything over a C because there's just no way anybody worked hard enough to get more than a C from that person, from that professor. And you have to put up with that crap. It's a really good way to prepare for the world. Or you can be like me, go to the school of hard knocks and live life dragging by, where when I started off and all my friends that went to college were making $10 an hour, I was making $18 an hour, and I was living a fat life back then. But then you look at the difference in progression. They graduated high school or college,
Just
sorry.
like you talked about with the trucking and you stay in that thing, the rate of return starts diminishing, right?
Right.
So you made a ton of money at the younger age, but because you didn't have that step up with the degree, eventually
Right.
that they did catch up to a degree. So.
And then they way surpassed me, like way surpassed me. And
Yep.
so it's not, it's the American dream isn't, hey, I shouldn't have to go to college, or hey, I should have to go to college. It's understanding that college is deferred gratification. You take a
Well,
lot
just like
less.
when you're picking a business and you're doing a startup, you got to see, does that apply to my goals and where I want to be? If you're going to college and you're just going to become a teacher,
right?
Nowadays, before you had to go to college, now you can go be a teacher without even going to college. You can get your GED and you can get a 2-year cert, and you're ready to go. So, or, I remember, because it was a big degree at TCU, and I had friends in. I'm like, what are you doing? Why are you paying? The answer was their family was really paying, but why are you paying for this return? And they were going into what's it called when you deal with adoptions and all that stuff, and child welfare. Social workers. A social worker. I'm like, why are you paying $50,000 a year to get out of college and become a social worker? And I get, if you're going to be a social worker, there's a gratification to a lot of people that do that because of the fact that they want to be in that, and they get more satisfaction from helping someone than they do having a ton of money. But
here's the thing that really sucks. That is such a selfless job, and we're going to go way down the wrong rabbit hole, and you've only got like 7 or 8 minutes left before you got to go. But man, not only is it, that's not really, this to me, that's not even deferred gratification. And the thing that really sucks is most of the time people will specialize in something like that. And like I told you guys before, you have to be in a niche market to really always have the capability of growing your business, but you can also put yourself in a niche that never makes money. You can be Keanu Reeves and literally be the exact same person every single movie ever. Or you can, be a comedian, right? Anybody else. Anyhow,
but I think it's gonna be a part 1, part 2. I think we're gonna have to continue this conversation,
right? So you can over specialize and put yourself to where you've worked yourself out of business. And somebody that's about to put themselves into a situation like that really is. Now on the flip side of that, you decide to figure out how to monetize social work, where you're no longer working for the government, but you went and you did your deferred gratification. You paid for your college. You got into social work. You helped out kids, but you see how gut-wrenching of a job this is. I mean, this is a sacrifice on every level because you don't make any damn money working in social work. I mean, you're talking $35,000, $40,000, but you can then in turn figure out
$200,000 education.
Yeah. And then you can turn around and if you can find a niche that makes money, you can still help those same kids. And people
forget that. You should look at it. I would compare it similarly to the environmental problem that we have.
Right.
In that, and hear me out on the, and this will be my last point before I escape the podcast. But you have environmentalists on one side and you have business owners on the other, and then you have the in between that are business owners and environmentalists. The catch-22 is, if the economy sucks, the environment is not going to get protected because you're not going to have technologies to protect it. If you go 100% environmental, look at LA right now. You've got all these things that they were protecting are dead. So everything that they tried to save money on that they were protecting is dead. and homes are gone, and people's lives are drastically changed. Even these millionaires that are over there, a lot of them either didn't carry insurance or got dropped with their insurance or whatever else. So while they may have money over you and I to recoup certain things, I would say if I was making $3, $4, $5 million a year and I just had a $2 million, $4 million hit on my house that was uninsured with all the priceless things in my, I mean, I remember Mel Gibson was talking about some books he had that were religious that were from the 1600s. Like that will never be recovered. I would say that's still a pretty big hit. You know, they had more
Right.
risk, they had more things that they did, and they lost more. So you know, keep that in mind in starting a new business and thinking about education. You know, if we go way back before you even start the business,
Yep.
is thinking about your goals in that, okay, if you want to go that route with what did we just say we were talking about with the social work? If you're going to go into social work, think about that. Think about the goals you need. Do you really need a $200,000 education to do that? Probably not. You can go to a local community
Right.
college first and then go to a college. You could
Because at the end of the day,
strategize.
well, not even then. At the end of the day, if you're going to try to figure out how to make money while you're being a social worker, you instead of spending the $200,000 in the 4 years of getting a degree to help you get in and earn an extra $5,000 in social work a year, start at the ground where all you need is a high school education. Get the 4 or
Get in the
5
ditches,
years
man.
of experience, and then when you go talk to Josh for a loan, you have the experience.
Yep.
Education doesn't matter. It's about the experience because
I have that argument with my wife all the time about experience because she thinks that she only went to college for 2 years, so she didn't graduate. But she's been in the industry of construction and commercial construction for over 30 years. I'm like,
right.
you can be an executive, and even here's the thing: even if they require the degree, they're going to pay for it at that point.
Yeah.
They're going to pay for it, and they're going to guarantee you. In fact, you're going to want to guarantee before you take that, before you say that you're going to do the school, and you say, "Hey, I want the promotion guaranteed. If I finish this education and you pay for it, and I finish, I'm getting that promotion. Otherwise, why would I? Because I don't need it."
Right.
So,
Right. Because she's been making good enough money for the past 30 years. Why would you go kill yourself after that?
100%.
So
Well,
deferred gratification is the word of the day today. So deferred gratification, folks. We're going to close it out here. We're closing out for the day. We will see y'all next Thursday. Yes, we will be on time this week. Yes,
everything will
we will
make
be on.
sense once we bring it back.
Right. So we will jump back into new year, new you, new startup next week. We do not have another person. Like, subscribe, comment, all the
We have
stuff.
us. We're just as big a
I know I'm not.
knowledge
I'm not
base.
that.
We've made all the mistakes. What are you talking about? We're the
That's
best
true.
representative for it.
That's true. That's true. So
Yeah, we love
we all
y'all
have.
in the new year. Have a great new year. Like, subscribe, and follow, and comment, and all that good stuff.
Yep. Y'all have a blessed week. We'll talk to y'all next week. Bye.
Bye.